I'm a believer that the biggest factor contributing to the returns in your portfolio is asset allocation. The amount of your portfolio you choose to invest in stocks, bonds, real estate, cash, anything else will ultimately have the biggest effect on how your portfolio does over the long run. So in other words, the decision of whether to buy Lowe's or Home Depot isn't nearly as important as the decision to be in large cap stocks or international bonds, for example. If you're being strategic about your saving, you'll probably try to utilize tax-advantaged accounts like IRAs, Roth IRAs, 401ks, and so on as much as you can. If you're using them like most people do, after a while your portfolio will probably be spread across several different types of these accounts. So this video today covers asset location. Rather than replicate the exact same asset allocation in each of these individual accounts, placing your investments strategically across them can work to reduce your tax bill and enhance your after-tax return. Since some asset classes are more likely to distribute taxable capital gains and income, parking them in the right accounts that you don't pay tax on, like a Roth IRA, only seems logical. When done thoughtfully, asset allocation can actually add as much as 1/4 to 3/4% per year to your portfolio's after-tax returns. So what is strategic asset location? At a high level, some asset classes are more likely to distribute taxable capital gains to investors than others. For example, growth stocks like Amazon and Netflix tend to reinvest their earnings rather than distributing them back to shareholders through dividends. On the other hand, value stocks, Coca-Cola, GE, and so forth, tend to give back a steady portion of their earnings through dividends to investors. These dividends are taxable. Capital gains, which is what you get if the price of your investment rises, are only taxable once you sell your investment. Now, asset location is the concept of placing your asset classes across your portfolio strategically based on the tax treatment of the accounts you're using. To use asset location effectively, you need to consider two different factors: tax efficiency and return. Logically, the asset classes that are less tax efficient should sit in the accounts that you don't pay tax on. So tax-deferred accounts like a traditional 401k or IRA work pretty well, since you're not going to pay taxes on them until you withdraw from the accounts in the future. Tax-exempt accounts like Roth IRAs and health savings accounts are even better, since you'll never pay taxes on the accounts again. So what is tax efficiency? Different asset classes have different propensities to distribute taxable gains and income to their investors. For example, value stocks tend to distribute those dividends to investors that qualify for favorable tax treatment. Commodities, on the other hand, are more likely to distribute capital gains that are taxable at higher rates to investors. The second factor is return. Very simply, the higher your income or gain from an investment, the more you're going to pay in taxes. Pretty logical. The more taxes you're subjected to, the more important it is to place the asset strategically in the right account. Asset classes with lower returns, like cash or U.S. government bonds, simply don't matter as much because they're not going to produce returns as high. That means that if you're going to use strategic asset location, the first thing you should do is prioritize each asset class in your portfolio. Start with the high return asset classes first and rate their tax efficiency. High return asset classes that will cause a big tax bill should go in your tax advantaged accounts. High return asset classes with lower tax impact should go in your taxable investment accounts. Everything left over, the lower return asset classes you have, can be used to fill up the unused balances across all your accounts. Asset location strategy will vary quite a bit based on the types of investments you own and the types of accounts that they're sitting in. As we covered before, the first step is to rank each asset class in your portfolio from highest to lowest expected returns. Emerging markets, small cap stocks should be at the top, and bonds and cash investments at the bottom. Next step is to rate each in terms of tax efficiency. The least tax efficient asset classes should sit in your tax deferred and tax exempt accounts. The most tax efficient should sit in your taxable accounts. The lower return asset classes don't matter as much because they can be used as filler to round out your portfolios in each of your accounts. And of course, the aggregate allocation across all of your accounts should match your portfolio objective. Just like strategy, the benefits of strategic asset location will vary depending on the types of accounts you own and the asset classes you're investing in. In general, the more of your wealth that sits in tax-deferred and tax-exempt accounts, the greater the opportunity. So if 90% of your assets live in a taxable investment account, you could still benefit from asset location, but you don't have as much room to play with and probably aren't going to benefit from the strategy quite as much. The more cash you can stash in tax-advantaged accounts, the more you can reduce your long-term tax burden. So this is where strategic asset location can get complicated. Oftentimes, the greater the opportunity, the more complicated the strategy becomes. When you have both tax-deferred and tax-exempt accounts, you will have more opportunity to boost returns, but figuring out how is probably going to take a little bit of work. And when it comes time to rebalance your accounts down the road, things can actually get a little bit hairy. If that wasn't bad enough, the picture gets exponentially more complicated when there are irrevocable trusts in the picture. Revocable trusts flow back to your personal tax return, but irrevocable trusts are considered a distinct, separate entity for tax purposes. While they are subject to the same tax rates that you have, their marginal brackets are very compressed. For example, married couples won't be subject to the top tax rate of 39.6% until they have more than $470,000 in annual income. Trusts reach this tax bracket after only $12,500. That means for asset location purposes, not only do you have to divvy up your portfolio assets based on each asset class's growth rates and tax efficiency, but you also have to do so versus income and non-income producing asset classes. So for that reason, if you're the trustee or beneficiary of an irrevocable trust, income producing assets should be placed in accounts titled to you as an individual. The trust should hold non-income producing assets like growth stocks. This way, your income producing assets will be taxed under your personal brackets and not subject to the top tax rate unless you make under $470,000 a year, or $418,000 if you're single. Here's when you shouldn't use strategic asset location. If you're saving for a shorter term goal in a separate account, it's probably best to omit that account from your asset location strategy. 529 college savings accounts are a good example here. If you're saving for your kid's first year or several years of college tuition down the road, a 529 account would offer tax-free growth. But that doesn't mean that you should invest the entire account in small cap growth stocks for asset location purposes. You'd be taking too much risk in an account you're preparing to withdraw from in a few years down the road. Yes, you might be diversified in terms of your total wealth, but if the market crashed in the meantime, you might need to withdraw tuition money from another less tax-friendly account. This concept really applies to anything that you have earmarked for specific goals down the road. Rather than using strategic asset location within these accounts, you should probably use a diversified portfolio with a risk profile commensurate with your time horizon. Okay, so how much can you actually save using strategic asset location? It's kind of a subject of some debate. Again, your personal results from thoughtful location across your accounts will vary based on the accounts you have and what you're investing in. Michael Kitces is a financial researcher that I think highly of, and he thinks that thoughtful location can add about 0.25% per year on average, and even range all the way up to 0.75% every single year. Now, 0.25% doesn't sound like much, but if you have $1 million portfolio, that's $2,500 just in year one. And if that $1 million portfolio grows at 8% over a 20-year period, that means that you'd have $4.3 million afterward. But if you employed strategic asset allocation and grew at 8.25%, you'd end up with $4.5 million after 20 years. That's an extra $200,000 that you've earned over a 20-year period just by being thoughtful about putting your assets in the right accounts.